Hello and welcome to the live one. Today is Thursday, October 27th. I'm your host, Priya David Clemens. Joining me here in studio today is Paul Sloan, executive editor of BNet. Hey, Paul.
Hi.
Good morning. Nice to have you here.
Nice to be here.
And our guest this morning is joining us via Skype. His name is Geoffrey Moore. He's the author of this recent book called Escape Velocity, Freeing Your Company's Future from the Pull of the Past. Geoffrey, good morning. Thanks for joining us.
Good morning, Priya. Good morning, Paul.
Good morning.
So I'd like to also invite our viewers to join us. You can be part of the conversation by writing in on the live chat window on your right-hand side of your screen. Bring any of your questions in, and we will get them to Geoffrey. Geoffrey, let's get started. Dive straight into your book. You talk a lot about working through power, not just looking at past performance. What does that mean?
Well, if you look at how companies are measured today, of course, a lot of their stock price and their management compensation is tied to what they did last quarter and their quarterly results. And there's a tendency, obviously, in management to then spend more and more resources against that short-term objective. It ends up trapping a company in its legacy businesses. And so this whole idea of freeing your company's future from the pull of the past is a way of trying to get more resources allocated to things that will create future positions in future categories and not just be optimized the businesses you're already in.
All right, let's take an example. Who would you say has done this in the past? Who's struggling from their success, basically, feeling trapped by it?
If you think about it, I mean, you look at HP, you look at Microsoft, you look at a lot of these big, wonderful companies, Intel, whatever. They've got terrific franchises. They're still vital franchises, but they want to get into the next generation of categories, and getting the right resources against that objective is very challenging. It's very easy for them to put R&D resources against the future. It's much harder for them to put go-to-market resources against that same agenda, particularly when those go-to-market resources could be used alternatively to generate higher performance in the current quarter. So a lot of the book is about how do you overcome that sort of momentum or inertial resistance toward reallocation.
Doesn't this get back to the innovator's dilemma, basically?
It sure does. I mean, I think Clayton got it absolutely right. The only sort of thing I think that marginal change I think in that perception over the last decade and a half is, I used to think it was an innovation problem. I used to think the problem was large companies couldn't innovate. I think what I learned from my last book called Dealing with Darwin was that was not true. There was an enormous reserve of innovation in these large companies. The bottleneck was getting it to market. And what happened was it wasn't hard to get the first $10 million, $20 million of the revenue. It was very hard to go from an order of magnitude beyond that to what we call materiality, to where it could be a business big enough to be material to the total franchise. And at that point, it ran into the new business would run into the inertial resistance from the old business, and inevitably it would get marginalized.
And is that simply because of the risk that companies have to take then financially to bring it to market?
I think it's a chunk of it. I mean, the truth is, as the larger you are, risk is asymmetrical with size. So as you become larger and larger, the truth is the less you have to gain from taking a risk and the more you have to lose. And so inevitably there's a kind of a Darwinian evolution toward risk-averse management. But the problem with that is you end up marginalizing the franchise, and eventually you get so marginalized you fade from existence. We've got a number of companies right now who are struggling. I would argue Kodak is struggling right now. I think Yahoo is struggling right now. And both of those, and HP arguably is in the midst of some struggles right now. And in all those cases, you think, we just didn't have enough material new businesses to take up the agenda once the current franchises began to get long in the tooth.
It strikes me that what happens is that the interests of the top executives aren't always long-term enough, just because they're thinking about themselves and their own career. I mean, we've heard obviously tons about Apple recently, but I think what gave him the guts to just ignore the short quarter results and and defy what Wall Street might have wanted immediately if you go back a decade was just that he was always looking at Apple for a longer term framework. And I don't know, it just seems like not enough executives think that way.
Well, to be fair, I mean, I would argue that Jeff Bezos is going to get a bunch of credit for the same kind of behavior.
That's because they're founders.
I think that really helps. Bill Gates, Larry Ellison, whatever. But so if we are only going to rely on founders, we're kind of in deep trouble.
Right.
And so if you look backwards and say structurally, what could we do to sort of rectify the balance? Because it's not like you don't want any performance in the short term. I think we have to look at the fact that in the marketplace, in the investment marketplace, I think this is the year that the average holding period for a share of stock will drop below 1 year. So all of a sudden, the people we call shareholders, they're really more like sharecroppers or share renters or share leasers or something else. And so playing and saying that they should be the number one voice in sort of the value creation decisions of companies, that's not true anymore. It's not, if investors were all Warren Buffett, the alignment between the investor and the employee and the customer and the management would be very good. But in a short-term market, as with the financial markets have become today, the actual quote shareholders are actually the odd men out in terms of interests. Their interests are not aligned with a company's customers' interests or the company's employees or the communities that the companies live in. And so we've got to find a way to rewrite that social contract with the investor.
So what do companies do? What does Yahoo do? What does Dell do? What does HP do?
Well, right now, unfortunately, they capitulate to short-term investor interests because the way the system is set up right now, it's very, very difficult not to do that. But that is not in society's interest. And I think a lot of the tear gas in Oakland and the stuff that's going on around here is a kind of an inarticulate but very passionate attempt to get the attention of the financial markets and saying, guys, we're no longer aligned with you. We used to be, but we're no longer aligned.
Geoffrey, you talk a lot about these solo managers that are, big players, Ellison, Fiorina, Jobs. How much does this really come down to these charismatic single leaders of companies versus more of a corporate culture, perhaps?
I think you can do it with a corporate culture. I think HP had a corporate culture prior to the last decade, which was very resilient and very adaptive and willing to do this balance between invest and harvest, because it's not one or the other, right? It's a yin yang kind of thing. And I think the outside, if you're outside of the system, it's actually not that difficult to see kind of what the right balance might be. The challenge is you get inside the system, you start looking at the compensation systems for these executives, and you realize they're massively overweighted to performance, inappropriately so. But that's the system they have. And so I don't think it's impossible. I don't think it takes heroic efforts. What the purpose of the book is to lay out a set of frameworks that says as a proposal, here is what I think are a reasonable set of frameworks within the existing sort of norms of society and investment in the financial markets by which we could re-engineer this balance to get it more in balance and therefore more healthy for corporations, both their present and their future.
So is there perhaps then best practices that we could look at in terms of resource allocation? And is there a way also to transfer this information, not just from these huge mega companies, but to the medium size and the small businesses?
You bet. By the way, this can happen. This happens to a small business just as much as a large business. There, the situation is you're in your own small business. Capital is tight. Obviously, the most liquid capital you have is your own time, and then you end up saying, where do I spend my time, and where do I take chances, or do I take a chance on entering a new service line or a new product line? Because if it fails, I'm very exposed. So it's not, leadership takes courage, and it's not that you should take, high risk bets all the time. That does not win the World Series of Poker. So understanding when to take those bets and talking them through with your colleagues and making the bets together, and wherever possible, making them iteratively so that you can take some smaller bets and sort of test out the waters. People say, fire a bullet before you fire a cannon, that kind of stuff. I think there's lots of best practices around there if we say this is where the management team needs to focus its attention. The danger is, particularly in the larger the company, the bigger the danger, is there's so much just work in running and making the short-term obligations work in a large corporation. It's very easy to talk about the long-term at an offsite and then frankly forget about it for the other 363 days of the year.
Why don't you talk about changes to compensation structures in general? You don't think that's just going to happen, or?
I think it can happen, but I think the issue is you've got to set up, if you say we're going to be accountable to the future, what we say is you have to be accountable to power, not just performance. And so that requires you to think a lot more articulately about power. How would you objectively measure power? Because if you could objectively measure, or at least have proxy measures for increasing future power, you can then start tying your compensation to achieving those metrics. The way we used to do is we gave people stock options. And the idea was, well, stock options will appreciate once investors realize you've made your company more powerful. But in fact, the financial markets have gotten out of sync with that. And so the current set of compensations just does not end up rewarding the investments in the future. And so you see a guy like Bezos, who's made a very big bet in the future with Kindle Fire, a very big bet in the future with, or you see the guys at Netflix making the bets they're making, and they're just getting hammered by the financial markets. And to some degree you say, okay, well, there's a performance part there that's worthy criticism, but there's zero credit being given to the investment in the future because the financial markets aren't going to hold their stocks for more than a year. So they just don't care. And any risk that puts that 1 year performance in jeopardy, they hate. And so now you've got a situation where the financial markets really are in danger of making themselves the enemy. And I have to tell you, the people in those markets are tone deaf. They cannot hear the voice of people saying, guys, pull back. You're over it. They're just frankly, a little bit like pigs in the trough. And it's not much fun to be on the other end of that if you're a management team.
But look, what you're describing is the casino that is Wall Street on a day-by-day or week-by-week basis, and it's often disconnected to the business, right? I mean, Bezos was considered a fool a decade ago, and his stock has done incredibly well. Apple, the same thing.
Sure. So what you discover is that, in fact, if you play the game according to the principles of long-term investing, and you are a long-term shareholder, that is a winning game. I mean, provided that you're a good leader.
That you do the right thing. Right.
Yeah, and you execute and do all that good stuff. But the disconnect is when more and more of the total capital in the market is weighted against much more short-term outcomes. And if the political pressure of that capital on the board of directors and on the management team is allowed to exert itself the way it has in the past, you're just not going to get the alignment you need to create these long-term outcomes. And the bigger problem we're going to have is, when you plow it down under one generation of companies and at least historically in the U.S. and in tech, another crop came up. But for the first time, we're in a century now where we are no longer the great domestic growth market for the planet. I don't know that we can grow an entirely new crop of companies in a world where we're going to be playing a lot more away games than we're playing home games. It feels to me like we better revitalize the franchises we have if we're going to play a significant role in the next 10, 20, 30 years of this world.
Our guest today is Geoffrey Moore. He's the author of Escape Velocity, Freeing Your Company's Future from the Pull of the Past. We're going to have to let him go in just a minute, but I know Paul has one last question he'd like to ask.
Well, I was wondering what you thought about private companies. I mean, it seems so much of the great innovation is coming from companies that don't have to face this short-term scrutiny.
I think the private capital markets are going to be a breath of fresh air for a while. I think it's not just the startup venture capital. I spent a lot of time with venture funded companies, but I think also private equity capital, which can take in a company when it needs to make one of these pivots, if you will. And when you're pivoting as an aircraft carrier, that's quite a pivot, right? But I think folks like Silver Lake and people like that tend to be able to do these kinds of things. They certainly did a magnificent job with Skype. I'm not sure that was quite they had quite the legacy of a Kodak, but you can see how you could take these companies private and maybe do things and with the thought that it's a 3 to 5 year journey before you're going to bring it back out to the public markets, and that does make sense.
Is that what Yahoo needs to go private?
Well, I mean, it would help. I mean, because I think Yahoo and HP and Kodak and companies like that, you get into a situation where you need to do some tough things, and the last thing you need is the yammering of a week-to-week analyst talking about how you're doing everything wrong.
Right.
All right, Geoffrey Moore, thank you so much for joining us this morning. We appreciate it.
Oh, my pleasure. Thank you.
And Paul, thanks for being here too.
Thanks. Enjoyed it.
And all of you, we've so enjoyed having you along for the ride. This is the last edition of the live one here on BNet. We're going to be merging with our long-term partner, MoneyWatch.com. The new site will be called CBSMoneyWatch.com. We hope you'll check it out. Thanks so much for joining us.